And so the first one is EML Payments. This is a company that over the last 6 years, we've sort of owned it, sold it, then bought it back. We've actually made a lot of money on this stock over the years. We obviously lost a little bit along the way, and then we made a lot of money again last year. And now the same thing as well. So essentially, this is a global non-bank card issuer. Now, it's probably the second largest in Australia and New Zealand, and it's probably one of the largest global gift card issuers as well. It's got a bit of a diverse market and products that it offers. It has employee benefits programs, which are like salary packaging. It does government disbursements, mostly in the UK. It does gaming, cash out cards and the like. It does travel cards, reward cards, and it's got some financial services as well. It's basically been a bit of a basket case since it had regulatory issues in mid-2021. Essentially in March last year, it had a refreshed board and management came along and essentially went through a process of resolving all the regulatory issues. That's all done. They divested all the non-core loss-making divisions. That's done. And now the pure focus with a new sort of growth-minded CEO, which presented their new strategy yesterday called EML 2.0, is really focused on growing and growing profitably. And so they got a net cash balance sheet, which is good. And they reaffirmed their guidance for this year, which is about 210 mil of revenue and about 55, 60 mil of EBITDA. They'll generate 30 mil of free cash flow. Although some investors don't like that a large part of the earnings come from the interest income they earn on the float, on the money that they hold on the card balances of their customers, it's actually a really good type of income. It's annuity. It is very cash generative and it's quite predictable. So it is part of the model. Now, it's a very attractive valuation. It's trading on an EV to EBITDA of about 5 times. The recent M&A transactions in the sector has been done at 10 to 14 times. So if you look on the left, the new strategy is essentially they're going to continue to grow for the next 4 years. They're going to invest a bit in the go-to-market strategy in terms of sales. At the same time, they'll have some savings from reorganization of their current cost base. They're going to invest about $12 to $15 million in a new tech stack to basically bring the whole global business onto the one single platform. That will take about 2 years, but it will generate about $12 million of annual savings at the end of that. So essentially, it will pay itself off really quickly. And they think that their core business is growing at about 5% per annum. And then on top of that, they'll have new business, which will add up to about 10 to 12% annual sort of top line growth. The EBITDA margins, as a result of that, with their cost base remaining flat, will sort of get to 35% in 3.5 years. And I think they can make about 95, 100 mil of EBITDA, 60 mil of free cash flow, which translates to 13 cents earnings per share. The stock is trading around 90 cents. Obviously, it's quite cheap. And we think that now that they've put forward this new strategy, the issues of the past has been resolved. It's almost like a no-brainer for private equity or someone else to come pay 10 times on the current year earnings, so maybe buy it for 500 or 600 mil, and then obviously benefit from the 3 years sort of forecast target. So we think it's a takeover target. And some of the contract wins, next year results and so on, and execution on this strategy will sort of see it re-rate over the next 12 months or so.